Hi everyone, it's Martin from the CIO office, and you're listening to the market review for the month of November. Uh, the month of November, again, a lot of volatility. It started on the wrong foot. Thank God we had some sort of a relief at the very end of the month, and all in all, it wasn't all that bad, as you can see on the chart on page two. Um, so we're glad to say that even though there's been a lot of volatility, we were able to end the month of November on a very high note, thanks to a more dovish Fed and some sort of a truce in the trade war between the China and the U.S. So the best weekly change in the past 7 years. So we're really happy. The problem is that we started December really on the wrong foot. As you can see, 3.2 lost in one day yesterday, one of the biggest daily change in 2018. But as you can see, it's been very, very volatile, and those gains in November were quickly offset by the uncertainty regarding the trade truce and also growth concern following the flattening of the yield curve, and I will come back to that in a moment. It's not to say, however, that things are all that bad. I mean, it's not the best year, but not the worst either. And we keep telling you guys, diversification is probably the most important thing in asset allocation, in portfolio management. And as you can see, a balanced portfolio is up almost 1.3% so far this year. So nothing really to write home about, but nevertheless, it's nothing close to those big 20% downturns if you're invested in some tech stocks or stuff like that that we've heard about on the news. And thank God this is all accountable for the Canadian dollar, which has been losing momentum. So it's again thanks to the diversification benefits of the U.S. dollar. We say that very often. If you're in the stock market, you got to diversify. You got to get out of Canada, and you got to do it on an unhedged basis. You want to make sure that if equities is the wrong bet, that at least you get a buffer or your investment is offset by the U.S. dollar, which more than often kind of acts as a hedge in against falling risk assets. And again, it's a very clear indication that's the way to go. That was the way to go so far in 2018. So not all that bad. Now the big question is, after testing the correction territory for a third time, and after seeing oil prices collapsing by nearly 35% since the top in October, is it really signaling the end of risk assets, or is it the beginning of something that's going to be a little bit more stable for the foreseeable future? Well, it's difficult to say precisely, but we do look at things such as the economic growth, and when you're looking at the manufacturing activity worldwide, there was a clear slowdown since the beginning of the year, especially in developed markets and emerging markets. But the U.S. remains at a fairly high level, as you can see, although it's slower than somewhere around springtime. But it's been accelerating lately, and emerging markets is sort of signaling that it's on the verge of rebounding. So something to work from. Nevertheless, we're not, hiding our heads in the sand here. We're not being complacent. Our models are acknowledging that there's an ongoing slowdown. It's really visible in terms of equity momentum, in terms of manufacturing activity momentum as well, and that's why our model is showing that we have a slightly lower risk appetite for the moment. What's going to make us change our mind, obviously, is things like the yield curve. There's been a flattening of the U.S. yield curve as of late. As you can see, the belly of the curve, that is the spread between the 5-year maturities and the 3-year maturities, is inverted, and that's a cause for concern because usually it's an indication that the whole yield curve will probably invert at some point in time. And as you know, the inversion of the yield curve has always been a very, very good signal of the coming recession. But we think that this inversion has more to do with the fact that the market is readjusting to a more dovish Federal Reserve. As you can see now, about 65% of the market is expecting no more than one hike in 2019. So that's something to acknowledge more. The Fed is going to be probably a lot less hawkish. And like I said in introduction, Jerome Powell of the Fed sort of acknowledged that we're probably closer to neutral than what he let us believe earlier in October at the market peak. So something to know. And even though there's an inversion of this at the belly of the curve, which has always been a good signal that the whole curve is about to invert, it doesn't really mean that a recession is imminent, as you can see on the chart, page 13. I think that we're more in the period that's very similar to where we were in 94, 95, when the Fed was actually raising rates from a very low level once again. So I think it's a very similar period. And as you can see, the yield curve started to reaccelerate or widen again a short period of time following that. So it's something that could very well happen in the near future. And even if we do get an inversion, as you can see on the chart, it takes about 12 to 18 months on average before you actually are in recession. And clearly, there's absolutely no signal, no indication that we're in a recession right now. It would be very surprising to learn from the NBER that we are actually in a recession. You know, the unemployment rate is a very, very low level. Confidence is very high. There's absolutely no indication whatsoever that we're presently in a recession. So that means that there's probably good equity returns to expect in the months to come, barring obviously an unforeseen shock to the economy. So the yield curve is something to look at, but not a cause for panic for the time being. Another thing that we look at obviously is credit spreads. Credit spreads have widened a little bit, so it's something that's that we do take a close look at, and we'll keep on monitoring in the following weeks. But so far, it seems that the widening of the credit spreads is due in large part to energy companies once again, due to the fact that oil prices collapsed during the month of October and until all the way until the end of November. So far, the whole market is down maybe 100 bips compared to treasuries. But if you look at that on an historical perspective, so going all the way back to 2000, you can see that usually you get high yield spreads to widen a lot more than that to signal that there's problems down the road. So we're not there yet. It's just a blip on this on chart 15. Nothing where oil prices collapsed took the energy sector in 2015 and 2016, and nowhere near where financials brought the market in 2008 that led to the great recession. So I don't think that we're there yet. And although we'll keep monitoring those spreads, I don't think that it's cause for panic just yet. Okay, going back to the energy correction. Well, it was quick and severe. You know, the market was up. It was very stable, going up and up and up for about 6 months, and then bang, in 2 months it lost about 35% of its value. And I think it's owing to about three very important things. The first one is that although there were sanctions on Iranian exports, the U.S. sort of granted waivers to 8 very important importers of Iranian oil. So it sort of created a glut for sometimes the markets were working with something like a 1.5 million barrels less of oil in the market. So that supply just came back very quickly. That while there was a sort of a build of inventories in the U.S. as well. So more oil from OPEC countries, more oil in the U.S. And it's clearly not a demand problem where we see volumes from China continuing unabating. So we don't think that it's really a demand issue for the price of oil. And therefore, there was also a very critical reversal of speculative positioning. Most investors on the street were long oil. Like I was saying, the oil, was very stable, augmenting at a very stable pace until the very beginning of October. But probably that reversal of speculative positioning sort of added fuel to the fire, like the title is suggesting on page 18. Turning to the Canadian market, obviously the spread has winding down to an historical high as of late, but new cuts from the Albertan government at height of something like a 350,000 barrels per day was at an immediate reaction to the market. As you can see, the spread between the WCS, the Canadian Select, and world prices has narrowed down almost to the historical average, as you can see on the chart. So that's going to be very helpful, and I think that's will probably help the Canadian market stabilize a little bit. But there's always going to be that supply glut in that supply problem in Canada. It's very difficult for us to get the oil that we pump out of the ground and also out of the country. So it's going to remain problematic until we find a way to fix that problem. We need those pipelines right now. The Albertan government said they were buying more wagons for the rail transports, but so far it might take a little longer than what we're expecting. And obviously, trucking is still very, very expensive. So, nevertheless, a little bit more positive news for the Canadian industry. So, all that to say that we continue to like risk assets more than fixed income. Obviously, long bonds have gone through their 3.25 resistance. As you can see, there was sort of a triple top. We were above that, and we're retesting that. But it's owing to the fact that there was, again, some sort of an adjustment from a much dovish Fed just recently. But I think there's a lot of that owing to the fact that there was probably massive short covering, as you can see in chart 21. Market participants were really, really short the bond market. So there was probably some sort of a surprise effect. We like the stock market for a few reasons. Like I said, the economic momentum is still there, but it's more a questions of valuation. As you can see, outside of a recession, never have we gotten a number this low in terms of valuations. When we look at an average PE ratio for the EFI market, emerging market, the Canadian market, and also the US index. And as you can see from that point, being outside of a recession, there was always a double-digit rebound in equities. So I'm not saying that we're going to get that, but I'm just saying that stocks are more than fairly valued right now. They're cheap on a historical basis, and therefore we're thinking that as soon as we're going to get the a very small positive sign in the markets, it should lead to a rebound in risk assets. We're acknowledging that there's been a reversal of leadership in this downturn. Namely, value has done a little bit better than growth stocks, and emerging markets has done a little bit better than developed markets. Nevertheless, we don't think that it's the end for tech stocks, for what used to be the leadership or the key stories in 2018. FANGs collapsed during the month of October and November, down 24% on average. But as you can see, it's not the first time. 10%, 20% correction has been the norm over the past 6 years, namely because the growth story has been spectacular as well. When you're up 400%, 600%, I mean, going down 20% from time to time is not something that should be abnormal, and we don't think that it's the end of the story for tech stock just as of now. As you can see, when you're looking at the total return index spread to its long-term trend, we're fairly values, and when we're looking at earnings over the last 12 months, there's been an acceleration in 2018. We all know that, but we think that it's in line with expectations for the years to come, and therefore, even though it might not be the FANGs that will assume leadership, there's a lot of good companies out there that can assume leadership going forward. Turning to emerging markets, clearly, again, there was an outperformance that started late in October and continued during the month of November, but our models are not really signaling just yet that momentum is large enough for us to increase our positioning from a neutral position right now to an overweight for emerging markets. So we're just going to wait for our models to confirm that really there's a persistence in that signal, which we're not seeing just now. So I hope I've answered a few of your questions. We've published our letter yesterday afternoon, so obviously there's more details into the letter. But if you do have more questions, feel free to send us an email or post on our Yammer website. Thanks for listening, and we'll talk again next month. Bye-bye.